what we now must do is we must now look into the theoretical underpinnings of the approach in a lot more detail. And the obvious place that we have to start is here. This next segment I will call What is Money? One of the points that we made is that one of the differences between the approach that we would suggest in the mainstream school, one of the approaches that we have in common with all of the heterodox schools, is taking seriously money, endogenous money, credit creation, and so forth. So historically, throughout all time, there have been two basic theories of money. A commodity theory of money, where money is literally a commodity, obviously a precious metal such as gold or silver. Secondly, the credit or the claim theory of money. And clearly underlying the premise of the AMM is a credit or claim theory of money, where money is just an entry. It could be a book entry, it could be a computer entry. It's just an entry in a ledger, literally a credit. That's Schumpeter's expression, by the way, the credit or the claim theory of money. Now, if you pick up a textbook on money, the textbook functions of money are usually given as a unit of account. But in neoclassical theory, that's not actually taken particularly seriously. The unit of account is a numeraire and so forth. It's not really a unit of account per se. It's literally a numeraire. You pick one commodity out of a bunch of other commodities to be the unit of account. The next one is given as medium of exchange. Well, when you're talking about exchange, immediately you seem you're back to barter. It's like almost, and I say for spot exchange on the spot, it seems that money is something that just replaces barter. Instead of handing over another good for another good, you hand over money for another good, but it's on the spot. You can almost imagine, handing over the money and the other person handing over the goods, and the deal is done. And then finally, what is given is money as a store of value, and it seems to imply again that does money have intrinsic value? Is money something which is gold or silver? So the textbook discussions seem to imply an underlying commodity theory of money, even though the textbook authors must be aware that this no longer applies in the modern world. And I put that next statement, if it ever did. Of course, it never did. Now, the credit or claim theory of money, much more sophisticated. And I'm quoted from two scholars, both of whom I did respect in the case of Sir John Hicks. Hicks' market theory of money. Hicks said, money is what is paid for a discharge of debt when that debt itself has been paid in terms of money. So it's purely circular reference. Like if money is electronic impulses in a computer, to pay off your debt, you have to cough up so many electronic impulses in a computer. Absolutely right, from Sir John Hicks. His title was not right. He calls it a market theory of money. He should have called it a monetary theory of markets. My friend Jeff Ingham, Cambridge University, wrote an excellent book, an economic sociologist, on the nature of money. And he elaborated, if you like, Hicks's comment by saying that all money is debt insofar as the issuers of that debt promise to accept their own money for any debt payment by any bearer of the money. And you can see we're, advancing into Kansas City territory here, where, of course, the Kansas City argument is that for the state money to be money, they must accept their own money in payment of taxes. Hicks also in that book put forward his view of what money is, and he didn't mention store of wealth at all. He mentioned just these two things. He said unit of account, in the sense of an abstract standard of value, right, and means of payment. And I'm using the sort of philosophical counts as here. What Hicks means by this is that whatever counts as payment of one of these debts. Now, that leads to two questions. Are means of payment and medium of the exchange the same thing? Definitively not. And that's one of the key, key differences between this theory and some of the other theories that we discussed earlier today. The means of payment is definitively the cancelling of a debt. And notice that timing is completely flexible. You know, you could pay in advance, cash in advance, but again, contrary to the neoclassical models, cash in advance is not the only thing. You can also don't pay till 2015 or 2016, i.e. you can incur a debt and you can pay it later. And spot exchange is just seen as a special case. Money as a means of payment covers spot exchange, but it doesn't emphasize the exchange of goods and services. It emphasizes the paying of debts. What has happened to the store of value function? Well, I mean, obviously the money, it would be a good thing in capitalism if there was a money which retained its value. Indeed, my real interest rate rule would ensure precisely that. But the store of value function per se disappears. It seems that the most two important ones are, in Hicks's terms, unit of account and means of payment. Now, if we do have a credit or a debt theory of money, we're implicitly arguing that the characteristic form of money in capitalism is bank money, and that involves both sides of commercial bank balance sheets. And in the modern banking context, I think we must just be clear, I put an embryonic commercial bank balance sheets there, that the deposit liabilities are what we mean as the money. The credit is on the other side, the asset side of the bank balance sheet, the loans and other instruments that they use to, that they can issue. So if we say there's credit creation, that means that banks have extended loans, but it implies that there's money creation on the deposit side to exactly the same thing. And this is the key to endogenous money. This is the idea that money is endogenous. The second thing is, why is there a hierarchy of money, which is a crucial feature of the operation of financial markets in the real world. We quote from Hicks again, if payments are made by the offsetting of debts and the debts are owing from different people, it cannot be taken for granted that all will be paid or will be paid exactly as promised. So the debts may well be of different quality. And so you get this hierarchy of debts, from base money, commercial bank money, all other promises to pay, because the debts are of different quality. And using very standard notation, this is like the top end of the pyramid, so to speak. Yes?
So I just have a question. Thanks. I have a question just going back a little bit between, for the difference between a medium of exchange and means of payment. Because even though you incur debt, you still buy goods for that, like with that debt. So I still don't understand the difference between medium of exchange and means of payment, because I think you still end up paying for goods and services with the money that you're borrowing.
Well, debts can be for other things as well. Like a medium of exchange implies that you're exchanging one thing for another. If you take out a debt, so that's money as well, isn't it? I mean, the means of payment is all inclusive. It includes the medium of exchange as a special case. Then it's, if you incur a debt in the form of money, what you hand over is money.
The mean of payment, you could look at it as when, like, the firm take a debt, then they pay it for the workers, which is main theory with the circuits.
Yeah.
And this is a mean of payment. It's not like exchange, because you are paying the workers, then the workers will use it as a medium of exchange.
Yeah, exactly. Yeah, good point.
You see the different. This is just a small example.
Yeah. Thank you. This is very conventional notation. I'm using the symbol H to stand for the monetary base. That equals to currency in the hand of the public plus bank reserves. The money supply is again currency in the hands of the public plus deposits in the commercial banks, and obviously defined as broadly as you need to in the contemporary economy. Now, this symbol H dates back to the days of monetarism, when the monetary base was called high-powered money. And it's not a good term. But I've kept H because what else am I going to have? 2 M's. So I've kept H because it's convenient to have a different symbol. And as you all know, the algebraic relationship between M and H is known as the so-called money multiplier, which depends on the banking ratios, cash to deposit ratio and reserve to deposit ratio. But as I think most people realize now, there is actually no reliable numerical relationship between H and M, because in fact all of the monetary base, the money supply, the cash to deposit ratio, the reserve to deposit ratio, they're all endogenous variables. So the idea of the money multiplier simply doesn't work. The way that banks keep in step, and I've used Keynes's phrase there, is not by restricting them to loaning out other people's money. That's a favorite phrase of the neoclassical school, but basically by adjusting their own deposit and lending rates when the central bank policy rate changes. I'm using this generic term, central bank policy rate, the overnight rate in Canada, federal funds rate in the United States. So let I sub 0 be the nominal policy rate of the central bank. Let I sub D be the deposit rate of the commercial bank, and I sub L the lending rate of the commercial bank. So the commercial deposit bank rate is actually a mark down. It wouldn't be a 2-for-1 rule, it would be a 2 for something rule. It's actually a mark down from the policy rate, so we can write ID is equal to coefficient M1 times I0. And so therefore, if M0 is the bank spread, the markup between commercial bank deposit and lending rates, then the nominal bank lending rate, IL, is equal to M sub 0 plus M1 times I sub 0. So therefore, it's reasonable to argue that the central bank can influence commercial bank lending rates and thereby the nominal value of bank balance sheets by changing the policy rate, but it's not reasonable to argue that there's any direct numerical relationship between the monetary base and the money supply as such. We then have to get into those issues that we were talking about, the hierarchy of money, and I won't take this very far. Obviously, why are the liabilities of the state central bank the monetary base of the system? Why are they reserves for the commercial banks? Here I would take very seriously the point of view of chartalism, which has morphed into modern money theory in recent years, which argues that it's the ability of the state to levy taxes and its obligation to accept payment in its own money, which is the key. And you're all familiar with Randy Ray's book, Modern Money Theory, a primer. The deposit liabilities of some subset of financial institutions, you might call them the member banks. In Canada, we would call them the direct clearers in this second tier, if you will, also count as money and comprise most of the actual money supply, and that's very much larger than the monetary base. And so why do commercial bank deposits count as money? Well, first of all, there is a convertibility promise. I mean, it's a strange kind of convertibility promise, one computer impulse into another computer impulse. And of course, you know, the Kansas City School would argue far more importantly, the fact that the state will also accept tax payments drawn on these banks, you know, in payment of taxes. All other promises to pay, you know, count lower in the hierarchy. You know, all other financial instruments, financial assets, and so forth. Now we move on to one of the advertised points of this course, some puzzles about money and finance. And Fredrick will have, you'll make them not puzzles by the end of the day. We talked here abstractly about medium of exchange, unit of account, and what is money. And we talked abstractly about the different economic theories, the methodologies of the different theories, the underlying assumptions of the different theories, I've come to the conclusion that one of the ways to understand these issues is not just by making those definitions, but trying to see how they actually work out, in practice, in actual things. And we've got altogether 3 puzzles about money and finance, and I hope it makes these things clearer. The first one is an archaic one, actually, puzzle number 1. It's by the Cambridge economist Dennis Robertson, writing in 1922, writing essentially on the velocity of circulation in money. And this illustrates, if you like, the neoclassical theory supremely well. And I'll just read it. On Derby Day, the Derby is a horse race in England. It's held at Epsom Racecourse in June, and it goes on to this day. 2 men, Bob and Zhou, sufficiently proletarian names, invested in a barrel of beer and set off to Epsom with the intention of selling it at retail at the racecourse at 6 pence a pint. The penny, the symbol D, was a penny that was in circulation in Britain at the time. It originates from the Roman denarius. So they're going to sell it for 6 pence a pint, the proceeds to be shared equally between them. On the way, Bob, who had 1 3-penny bit, 3-penny bit is a coin worth 3 pennies, began to feel a great thirst and drank a pint of the beer, paying Zhou 3 pence as his share of the market price. A little later, Zhou yielded to the same desire and drank a pint of the beer, returning the 3 pence to Bob. The day was hot, and before long, Bob was thirsty again, and so a little later was Zhou. And you can see what's going to happen. When they arrived at Epsom, the 3 pence, the 3-penny bit, was back in Bob's pocket, and each had discharged in full his debts to the other, but the beer was all gone. One single 3-penny bit, or 3-penny bit as it used to be called, had performed a volume of transactions which would have required many shillings. The shilling is another coin that was in circulation at the time, worth 12 pennies, if the beer had been sold to the public in accordance with the original intention. So what do we make of this? Because this illustrates, in a sense, all the issues that we've been arguing about up to now, like the premise of neoclassical economics, maximizing utility, what is money, what's the purpose of the exercise, and so on. I think it illustrates it in a very good way. Well, what is missing from this account of Dennis Robertson? Well, if you look at it from a purely business point of view, and here I agree with Fredrick, look at it from a business point of view. Well, the whole episode seems and is disastrous. The entrepreneurs have literally drunk the profits, right? It's a classic case of the whole thing going wrong. But if you notice, Dennis Robertson doesn't even notice this. His point is to illustrate the concept of the velocity of circulation of money. How many times the 3-pence bit can go round. In reality, the story demonstrates the utter emptiness, the complete emptiness of the velocity of circulation content. And indeed, if we think of our neoclassical economics, there's actually nothing wrong at all with this situation. And Robertson doesn't think there's anything wrong with the situation. The beer has been produced and drunk. It's given utility and satisfaction. It does not matter to whom. There's been an optimal allocation of resources. Utility is maximized. But you can't take that to the bank, I'm afraid. And that's the critique of all of neoclassical economics. I mean, there's nothing wrong with this situation. The economy is working perfectly well. Just different people have drunk the beer. It's false, simply. So it seems that the neoclassical theory of utility is not an accurate theory of capitalism. So that's one of the reasons why I was making those methodological points that I was. The reason it's not an accurate theory of capitalism is that there is no mechanism within it for the realization of profits in monetary terms. Realization is a term that originally comes from Marx, but all it means is getting money actually in your hand, literally realizing the profits. By the way, there is also nothing amiss from that story from the perspective of either Marxism or classical economists. Both Marxism and classical economics have a real theory of value, a labor theory of value. However, nobody's being exploited in this particular case, although certainly the entrepreneurs had the intention of making a profit. And the idea of profit as exploitation does not work in these particular circumstances. So the takeaway of this is that money profits, the ability to realize money profits, are much more important in reality. They're decisively important in reality than they are ever allowed to be in theory. You know, the error of the Eurozone is to imagine that you can run a capitalist economy without a mechanism for the realization of profits. I flesh out the transactions velocity of circulation. The transactions version of the quantity theory for this admittedly microeconomic example would be M times V is equal to P times T. Money times velocity is equal to price times transactions. So let's suppose there are 20 transactions, 20 pints of beer. The money supply is 3, the 3 pence. The price level is given to us, it's 6. And we've now said that T is equal to 20. So Robertson's point would be that the velocity of circulation is equal to 40. And it could be anything you like. It could go up to any number. And that saves, if you like, neoclassical economics. Okay, I hope we're now satisfied. The next puzzle is Marx's monetary circuit. And this, this is a kind of complicated version from Das Kapital, 1867. And I use the notation M, C, C prime, M prime. The entrepreneurs start with a sum of money, dollars, M. They then buy some commodities, C, valued in Marxian terms, including raw materials plus labor time. They then engage in production using these commodities C to make is more. Now, here's the leading question. What do we mean by more commodities? Well, we mean more valuable commodities. So in some sense then, C prime minus C is the real value added. So the entrepreneurs then sell the enhanced commodities C prime for more money, M prime. And the difference M prime minus M is what we mean by the realized money profit. And obviously the C minus C prime would be the surplus value in the Marxian terms. Anyway, this is a description of capitalism according to Marx. And strangely, it's not too dissimilar to the views of Weber, Schumpeter, Keynes, and others. What is missing from Marx's account? First, we would need to define real value, which is an old question in economics. And obviously, both Marxian and classical economics define this by the labor theory of value. Neoclassical, mainstream, and Austrian economics define it by utility. More to the present point, though, with the great respect to the questions that were asked, I mean, the point is that both Marxian theory and classical theory have a real theory of value. That's the fundamental point, okay? More to the present point, if the money supply is fixed, how can it be possible for M prime to be greater than M? And that's a crucial question. Neither Marx nor the classical economists nor neoclassical economists ever seem to ask the question, but modern accountants do ask of it of businesses every day. Note there's a similarity there to the problem in the Robertson story. Again, there's a theory of value implicit in the Robertson story. There's a theory of value implicit in Marx. In both cases, those theories of value are unable to be realized, and that I do insist is the crucial point. Now, it would still be possible for some firms to make profits while others make losses. This is the usual meaning of competition, but that's not the answer. Because if someone makes a profit, someone makes a loss with the money supply fixed, it's still impossible for firms on average in aggregate to be profitable. The system as a whole cannot function on the basis of zero aggregate profit. I would say for the simple reason that expectation of success in any particular business would be zero and hence no incentive to act. And so the answer to the question that I'm asking, which is not the validity of alternative theories of value, I intend to interpose my own theory of value. The answer has to be credit creation, money creation by the banking system. Now, in modern economics, real value added is not usually defined as embodied labor, but real GDP. You know, the typical Y equals C plus G plus exports minus imports. So Y equals C plus I plus G plus exports minus imports. So our circuit becomes MY, you know, Y being defined as real value added M prime. But if we have M prime equal to M, there is no Y, no output. Why? Because there is no incentive to produce output. Why? And as you pointed out, even if M prime was greater than M, even if there was more money somehow kicking around, it is still possible for there to be no Y, and then the circuit just becomes M prime. And this is the case where all the borrowed money goes for financial speculation, etc., and nothing is actually produced. So that's obviously a possibility which was already raised in the discussions that we had. Now, again, suppose that we do have M greater than M prime, M prime greater than M, greater than 0, and also roughly equal to Y, presumably prices will be roughly stable. So here's a situation in which there has been credit creation, the money supply has expanded endogenously, and there has been real value. And as I say, our primary interest is not how to measure that real value, but that the money should correspond to that real value. If Y is greater than 0, but M is still greater than M prime, so there's still some production, but obviously perhaps a lot of financial speculation, et cetera, or just a lot of excess money creation, then prices will rise. So here's the two puzzles, and the reason I wanted to do this was this is a standard neoclassical account, and the problem was there's no mechanism for the realization of money profits. This is Marx's monetary circuit, also underlying it a real theory of value, in this case the labor theory of value. Again, the point is we haven't provided for a mechanism for the realization of money profits. And the answer, as I say, the answer has got to be, we saw that money is just one side of a bank balance sheet, credit is the other side of the bank balance sheet. So in order for there literally to be M prime greater than M, there would have to be credit creation. Someone somewhere must go into debt in order to provide profits for others. Now, that does not mean, when we make that point, this is not funny money in some sense, because in this next slide, we do distinguish between nominal and real profit. Like, I mean, we're not just saying here, unlimited credit creation is the answer to the cause of the exercise. We pointed out explicitly that if all the credit creation goes for financial speculation, etc., you get M greater than M prime. But unless there is credit creation, there can be no production. And I think this is one of the main points of circuit theory, post-Keynesian theory, modern money theory, and all of the heterodox money theories.